broad and quick overview of the key tax proposals, and I'm happy to take any questions during the panel discussion. So let's straight away move into the proposals on the direct tax front first. Firstly, let's look at some of the key proposals concerning individuals. Nothing much in store as far as individuals are concerned out here. If we look at the existing tax rates, they have been left largely untouched except for individuals earning income in the slab of 2,50,000 to 5 lakh rupees per annum, wherein the rate of tax has been reduced from 10% to 5%. Correspondingly, there was a rebate which is available to individuals. The threshold for that rebate, which was hitherto 5 lakh rupees, has been reduced to 3,50,000, and the amount of rebate has been further reduced from 5,000 rupees to 2,500 per individual. At the same time, a new surcharge is now proposed to be levied on individuals earning income in the bracket between 50 lakh to 1 crore per annum, and that's likely to significantly increase their tax burden annually. And the surcharge of 15%, which was applicable to individuals earning income in excess of 1 crore, remains intact, so no change as far as that is concerned. The education cess of 3% again remains intact, no changes on that front. So essentially, two key things out here: rate of tax for individuals between 2,50,000 to 5 lakh of income reduced from 10 to 5%, and a 10% surcharge introduced on individuals earning income between 50 lakhs to a crore. Let's move on to some of the other salient proposals as far as individuals are concerned. There's a welcome proposal to say that any withdrawal from national pension scheme by employees up to 25% of their contribution will be tax free. Withdrawal beyond that will be taxable, but any withdrawal up to 25% will be tax free going forward. One major blow to individuals vis-a-vis taxation of income under the head house property. So we have a new proposal which says that if you have a loss under the head income from house property, that loss shall be allowed to be set off against income from any other source only to the extent of 2 lakh rupees. The balance loss will have to be carried forward to subsequent years. What this means is that take case of individuals having a self-occupied property on which there is no taxation of income from house property, and there was a loss up to 2 lakhs allowed. And how does the loss arise? If you have got borrowed funds on which you pay interest, the interest results in a loss because you have no taxation on the income from house property in case of self-occupied property, and the interest results in a loss. So there we had a provision which said that such a loss will be allowed maximum to the extent of 2 lakhs. But over and above a self-occupied property, if an individual was to have one more property, which could be again either a deemed let out property or an actual let out property, in those cases, whatever be the actual amount of interest, even exceeding 2 lakh rupees, used to be allowed as a set off against other income. Going forward, that has been restricted only to 2 lakh rupees. So other than self-occupied property, if you have any other property on which you incur expenditure by way of interest exceeding 2 lakh rupees, there will be a maximum cap of 2 lakh which will be allowed. The balance interest will have to be carried forward to subsequent years. No increase whatsoever in slab rates or deduction under ATC as far as individuals are concerned in this budget. Let's quickly move to some of the key corporate tax proposals. For companies having turnover up to rupees 50 crores in financial year 2015-16, there will be a reduced rate of tax which will apply going forward. They will now be subject to tax at the rate of 25% as compared to the normal rate of 30%, which is applicable to all other companies. One important point to be noted here: the turnover criteria needs to be looked at for financial year 15-16, not FY 16-17. So if the turnover during FY 15-16 was less than 50 crores, assume that the turnover in FY 16-17 will be deemed to be the cost of that asset in your hands, so that in the future if there is any disposal of that asset, you will not be governed by the actual cost of the asset. You will rather have an option to take into account the FMV as on 1/4/2001 as the cost of the asset. And after stock exchange, we have this provision, section 1038 in the Income Tax Act, which says that if somebody sells any shares on the stock exchange, and if these shares are held for a period of more than 12 months and qualify as long-term capital gains, that capital gain is exempt from tax. provided securities transaction tax, or STT in short, is paid at the time of such sale. It is now proposed that apart from STT having to be paid at the time of sale of such shares, if such shares have been acquired after 1st October 2004, then such shares should have suffered STT even at the time of acquisition of the shares. So if STT has not been paid when the shares were acquired, then this benefit of long-term capital gains exemption will not be available. However, taking note of some genuine cases wherever taxpayers may have acquired shares, say pursuant to an IPO or ESOPs being issued to employees, where there is no occasion to pay STT when the shares are allotted. That's something which has already been noted by the government, and they have announced that we'll come out with a list of exceptions which will not be subject to this taxable event. One other very welcome proposal which involves tax implications arising on account of conversion of preference shares into equity shares. Until now, it used to be a debatable issue as to whether such a conversion would result in a taxable event or not. It has now been clarified that going forward, any conversion of preference shares into equity shares will not result in any taxable event. Of course, it now opens up a new controversy about what about all the conversions which have happened before this amendment has come into play. One more welcome proposal in the context of Section 54 EC, which provides for investment-linked capital gains tax exemption, so that if you earn any long-term capital gains which is invested in certain bonds up to the limit of 50 lakh rupees, then that capital gain is exempt from tax. The mode of those investments have now been expanded to say that apart from the two bonds which have currently been specified, going forward, investment in any bond which is redeemable after a period of 3 years, as may be notified by the central government, will qualify for this exemption. So again, a welcome proposal. One proposal which is likely to act as a dampener is the one on the last proposal on this slide, wherein what is now being envisaged is that in case of transfer of any unquoted equity shares, while working out the capital gain, one will not take into account the actual consideration received for the transfer of the shares. Rather, we'll have to take into account the fair market value of the shares if the FMV exceeds the consideration received on transfer. So you'll have to take into account the actual consideration or the FMV, whichever is higher, while working out the capital gain. This in fact could have an unintended consequence in the sense that where shares are transferred to somebody at less than book value, there could be a double taxation event out here. From the transferor's perspective, the difference between FMV and the consideration received will be taxed as capital gains, whereas from the transferee's perspective, the difference between book value of the shares and the purchase consideration will be taxed as income from other sources. This seems to be an unintended consequence, but we could have a double taxation out here wherever shares are transferred as less than book value. A quick overview of the tax regime pertaining to non-residents in India. We have this provision which provides for a liberalized rate of withholding tax of 5% on any interest paid on external commercial borrowings if the borrowing happens on or before 1st July 2017. Now that date has been extended to 1st July 2020 to say that borrowings up to 1st July 2020 will qualify for this lower rate of tax. Similar benefit being extended to borrowings even in the form of a rupee denominated bond, what is popularly known as masala bonds. Similar rate of 5% withholding will apply in those cases as well. As regards the indirect transfer provisions which were introduced into the law to overcome the Vodafone controversy, a specific exception has been carved out therefrom to say that where any non-resident makes any direct or indirect investment in a category 1 or category 2 foreign portfolio investment, such investments will be outside the purview of indirect transfer provisions, a welcome provision for all private equity funds, venture capital funds, which have invested huge sums into India in the past. Very quickly, as far as the key transfer pricing proposals are concerned, one of the major rigors which taxpayers used to face was in respect of transactions between Indian group entities. Even they were subjected to transfer pricing provisions which did not make any sense at all. So that rigor has now been used to say that unless there are any transactions between Indian related parties which are eligible for any profit linked deduction, only those cases will be subject to specified domestic transfer pricing. All other cases wherein no profit linked deduction is claimed by either of the parties to the transaction, the SDT provisions will no longer apply going forward. we've now introduced what we call as a concept of secondary adjustment in the context of transfer pricing. Due to paucity of time, I will not touch upon that in greater detail, rather move to the next point immediately. A very, very important amendment proposed, taking a cue from the OECD BEPS report. The government has now introduced a limitation on the deduction of any interest on borrowings by an Indian entity from an overseas group entity. So if there is a borrowing by an Indian company from an overseas group entity, interest on such borrowings in excess of 30% of EBITDA will no longer be allowed as a deduction. The excess interest will, however, be allowed to be carried forward for a period of 8 years for subsequent set-off. But during the year under consideration, the maximum deduction will be restricted to 30% of EBITDA. So all companies which are highly leveraged, who have huge borrowings, who made some significant investment in infrastructure sector, real estate sector, in the initial stages, you may observe that they may be incurring huge losses. And in such cases, wherever there is an interest payout to an overseas group entity, all those interest expenditure will stand to be disallowed in the absence of any EBITDA of such companies. Moving on to some of the other salient direct tax proposals. We had this proposal which was introduced in the last budget to say that any dividend income received by individuals or HUF in excess of 10 lakh rupees would be subject to a 10% tax in the hands of the individual or HUF. This provision has now been sort of expanded so as to apply to all resident taxpayers, barring domestic companies and trusts which are exempt under section 1023C. One more very important proposal out here in the context of taxability of receipt of any specified property for a consideration which is inadequate or without any consideration. In such cases, the difference between the FMV of the property less the consideration paid for acquiring such property will be subject to tax as income from other sources. The list of the specified properties have been specified, and there are some exceptions as well which have been carved out in this regard. Some important announcements as far as startup companies are concerned. We have this provision, section 79 of the Income Tax Act, which says that in the case of a private company which incurs losses, if there is a change in shareholding exceeding 49%, in such a case, such losses will lapse and will not be allowed to be carried forward in the future for offset against future profits. So there is a carve out for startup companies to say that even if there is a change in shareholding more than 49%, but so far as the original shareholders hold all the shares in the company in the year when the loss is claimed to be set off, the benefit will be available. One more advantage for startup companies, they will now be entitled to 100% tax holiday within a period of 3 out of 7 years post incorporation of the company as compared to 3 out of 5 years in the past. Some reduction in the time limit as far as assessment proceedings, reassessment proceedings and revised tax returns are concerned, sort of a procedural amendment. Coming on to the last slide on the direct tax proposals, the time limit for issue of refunds for tax returns again has been liberalized. We currently have a provision which says that wherever a tax return is picked up for scrutiny by the tax office, it shall not be necessary for the tax office to process that return and issue the refunds. They are now saying that even in cases which are picked up for scrutiny, the tax officer will have to issue the refunds within a time-bound manner. So very, very welcome proposal. A slew of measures, relevant for the real estate sector. Because of paucity of time, I'll just skip through those points. And quickly moving to my last slide, which deals with the key indirect tax proposals. No major proposal on the indirect tax front, given that GST is now on the anvil and expected to become the law effective 1st July 2017. There are no major changes in the indirect tax rates. One very welcome development, R&D Cess Act has now been repealed. Other than that, the entire focus of the government is on enactment of GST and ensuring that going forward we are able to entirely streamline the entire indirect tax regime in India. So with this, thank you so much for a patient hearing. I'll be happy to take any questions during the panel discussion. Thank you.
Thank you, Mr. Himanshu Parekh. I had to cut you short because of lack of time. He's explained in some detail the specific proposals pertaining to personal income tax, various kinds of taxes on corporate entities, securities transaction tax, capital gains, tax on non-residents, transfer pricing, among other issues. May I now request Dr. Siddhartha Roy to give us his views on the budget, and then we can have a discussion.